More than half of the S&P 500 companies have reported so far, and our guest says the earnings growth is the strongest since Q4 of 2021. However, investors are demanding returns from AI investments. And of course, we did get disappointment over growth in cloud revenue at Microsoft, Google, and Amazon. Let's get more from JJ Kinahan, CEO at IG North America. JJ, great to see you. Thanks for joining us.
Thank you for having me.
So the earnings picture, pretty good. Profit still rising?
Yeah, I mean, it's been a really good earnings season. And let's face it, when you are trading at the levels we're trading at right now, that puts a little bit extra pressure on firms to come up with good earnings or at least a good story. And as you said in the opening there, I think the real challenge for the tech industry right now is you spend billions on AI. What's the return? When can we start to see the return? So far, it's led to some pretty cool search engines, but what beyond that overall? I really think with the DeepSeek news a couple of weeks ago, as we as we have seen, some of that actually was a little bit conflated. But that all said, I think it's also been a nice wake-up call for some of these tech stocks. And I think the really big difference in this last earnings call, and something I would expect to continue in a much heavier way, is analysts really starting to ask some questions about what's the money going for, when can we start to see return on investments, et cetera. I mean, at the end of the day, the Mag 7, et cetera, and some of the stocks just below them are sitting on such vast amounts of cash. They are trying to figure out the best way to deploy that cash. It does make sense to pursue this, of course, but Wall Street is a very impatient place and wants to start seeing returns pretty quickly.
That's interesting, isn't it? Yeah, because we know that productivity can take years to pick up after the introduction of new technology, and so profits could be slow in coming.
Well, they may, and I think the other thing that becomes a major concern for so many people is if AI can fulfill many of the promises that have been made, what does it actually mean for the job market? Because with every major, throughout the industrialized history, for every major improvement, there has been this little bit of a setback time where jobs take a hit, and then people figure out the best way to go forward from that, and it actually ends up creating massive amounts of jobs. But many people have to make a transition in that period, which can be a very, very difficult time. So I think as we continue to look at the labor market going forward, that also becomes something that people are very nervous about.
What about McDonald's? A great, dependable company over the decades. And of course, they've been shaking up the fast food industry, certainly in the U.S., with continued price cutting. Is that a stock that attracts you, or are you attracted to the restaurant space generally?
Well, it's a really tough space in general. It's interesting. We've seen our clients buying this stock quite a bit over the last couple of weeks. I was joking with a friend of mine. The reason the stock's up today is, of course, it's the beginning of Shamrock Shake season. But more realistically, on the earnings, the bad news was that same-store sales were down in the U.S. The good news is that more people were in the stores. It's just a lower ticket item, so lower margin per sale. Now, that said, internationally, this stock did very well. You report every day on how the inflationary prices, particularly in food, has affected some of these prices so much. And breakfast being such a big part of what McDonald's does, the higher price in eggs, et cetera, they get affected directly. So if you look at what they have to pay across the board, pretty much every step of their ecosystem now has higher prices than it did 2 to 3 years ago. And so with that, one of the things they've had to continue to adjust is what will be the margin on what they're going to make off customers, because you want to raise prices. But as to your point, they're finding ways to continue to be affordable. Reading some of the analyst notes off this morning's earnings call, I think that's one of the primary concerns that people have going forward is, will the average person be able to continue to afford to go to McDonald's as frequently as they do right now?
What about Coca-Cola, another legendary blue chip stock in the United States? And it's interesting, Bloomberg says that they've had unexpected success with their milk brand, so they're able to diversify nimbly in that area.
You know, look at the history of Coca-Cola, and they've always been able to find a way, if you will. We'll throw the new Coke debacle of the late 80s out the window, but outside of that, they always find a way. One of the other things that they've been particularly good at is finding ways outside the Americas to grow their business overall, and they continue to do so in an organic fashion, getting new products on there. As you just mentioned, the milk product, I think, has been probably, I don't want to say a head scratcher, but probably one of the most surprising things that any of us have seen. You just don't associate Coca-Cola with milk. But as that said, as I think there's maybe a bit of a concern with how the health benefits of new cabinet members in the Trump White House coming in, how they're going to look at all the sugar in some of these drinks, et cetera, although of course the diet drinks are doing very well also. So again, they continue to be a company that leads and looks for new products and places to go overall. So it really is a great story in terms of, you don't normally say soft drinks and innovation, but at the end of the day, that truly is what's going on.
Yeah, it's really interesting. This Fairlife milk, apparently they filter it to boost protein and cut the sugar, eliminate lactose, and apparently it tastes creamier. So interesting that Coke can find a new trick there. What about Lyft? Is that a stock that attracts you? I think a lot of people see it as an also-ran to Uber.
Well, that's exactly it. If I look at how our clients are trading it, Uber is a stock that continues to draw interest. Lyft is one that I think struggles overall. Again, if you think about, I go back to a lot of these things in terms of brand recognition. Like you said, Coca-Cola. Many people use Coke as a generic term for a soft drink. Mm-hmm. I think people use Uber now as a generic term for a ride service. So that's the level they've come to. That makes a Lyft. It makes it very difficult for them to continue to challenge, if you will. They have to stay in there and do so. But when you're going up against somebody that's being used as a brand, as a generic term, that makes that a very difficult proposition longer term. So it's one that would make me a little bit nervous.
Just finally, JJ, give us your thoughts on tariffs. I know it's very hard because Mr. Trump has been zigzagging. The Wall Street Journal says investors are deciding, this is a negotiating tactic rather than fixed policy.
Well, look at his first term. He did I think there is a little bit of a pattern to how the president does it. He comes out, he makes a big statement, and gets, particularly the press, maybe a flutter, and other flutter, and then he continues to back off that statement till he gets to the place that he really wants to get to. And in the meantime, he's negotiating with whoever may be on the receiving end of that first big statement. It's a pattern we saw throughout the first administration. It seemed to work with some pretty good success overall. I don't know why people would expect him not to continue with that. And so through the next 4 years, I would expect that we will get a lot of big statements where people are like, oh my God, I can't believe we're going to do that. And then 4 months later, it's some sort of form of that original big statement.
JJ, thank you very much indeed for joining us.
Always a pleasure. Have a great day.
JJ Kinahan, CEO at IG North America.